I think the S&P 500 is extended at these levels. We've hit the key 1618 golden ratio, and I think we're long overdue for a pullback. However, me thinking about it is simply not enough. We need to see actual empirical proof within the markets. And in today's video, I'm going to show you how you can very easily crack the market open and x-ray it to see what is happening underneath the market. How can you gather the breath and make a smarter decision of when and if this pullback is actually going to come? Now, to do this, we're going to use one very simple tool, and that's the market pulse indicator. From the market pulse indicator, we also have the utility labels. Both of these are free downloads, and I'll leave a link to them in the description box below. Now, let's start first with the market pulse indicator. The market pulse indicator makes it very easy to see which one of the 4 different market stages we're currently in. You'll see that plotting inside of this label along with on the line on your chart. The line will be either green for acceleration, which is the bullish market pulse stage, or red for deceleration, which is the bearish market pulse stage. In between, you have the chop. The more bullish chop is accumulation. The more bearish chop is distribution. So those are the 4 different market stages. Very easy to follow along. Now, the key here is when you combine these 4 market stages, not just on one market, but on the entire broader market universe. We look at a key group of symbols, and using those symbols, we've built together our own proprietary market breadth indicator. I'll share that in just a second, but first, let's take a look at which sectors are leading the way and which sectors are currently lagging in terms of the broader market. So I said I think the S&P is overextended here, and that was based off of the golden ratio. However, if you start to load in the utility labels indicator focused on the sectors, that tells you the first layer of analysis. And we can see there that XLK is the one sector leading the way to the bullish side, and XLC is the one sector leading the way to the bearish side. In between, everything else right now is still currently chopping around. So, as of right now, we know that we don't see any clear indication, and you can also see that on the S&P 500 chart, just a whole lot of chop around our golden ratio. So now we bring in the market breadth. I think the market breadth is the easiest way to essentially x-ray the market. And we plot that right down on our volatility box platform on the today page, and you can read it very simply. This is what's happening over the past 10 days, and if we take a look on May 11th, for example, the bulls had a lot more control compared to the bears. 41% market breadth tilted to the bullish side, 18% towards the bears. So very clearly strength on the bulls. Now take a look to see what's happened to this bullish strength over the past 10 days. You'll see that that breadth has decreased. Very clear, very easy to see. 41% down to 40, fluctuated a little bit, and now we're currently at 34%. So on May 11th, we were at 41% with the bulls very clearly leading the way, 41 versus 18. Now we're seeing 34 versus 31%. So any day here, I'm expecting this breadth to shift, for this number to actually shift where the red side is leading the way. And that is going to be my very clear cue when that number shifts to red that, hey, we now have the market breadth, the actual underlying market, telling us that we have a lot more bearish symbols, bearish activity, bearish sectors than bullish symbols, bullish sectors, and we're looking for a pullback. In terms of the pullback level, the very first easy level I have on my chart is 72.30, and after that, I'm looking for the 1000 or 100 extension, near the 700 mark. So 72.30 and 7,000 on the ES futures. Now, before we wrap this video up, we come into SPX and you take a look. Actually, I think this is easier to see on SPY, but take a look at the weekly expiration for this particular week. To me, very clear that this particular strike here, 755, is the one with a lot of open interest on the bullish side. If you were to take a look at any other strike here, it's not really standing out the same way as a 755 strike stands out. You look on the put side, you have the 750 strike that's standing out with 20,000 volume. But in open interest, we have 755 that stands out. So if we come into SPY, we have 750, 755. That gives us a very small, narrow range in which we're looking for the S&P to chop around this week. Combine that with a small holiday week, makes a lot of sense to see some sort of decision taking place next week. And instead of guessing, I think you can look at the market breadth to look at where that decision is kicking into gear. Are we all of a sudden seeing that the bulls are stepping right back in and this number's increasing from 34% back up to the 40s? Or do we see this number decrease and finally the bears take over and we see for the first time in a while that the bears have taken over the market and it's time to start to look at initiating shorts or at the very least taking off longs? I hope you found this video helpful. As a quick summary, we started this off with understanding what are the 4 different market stages. I showed you how the market pulse makes it very easy to see which one of the 4 market stages we're in on any symbol you're looking at. And then we analyzed sectors first using the utility label sectors. We saw as of right now, the sectors are giving us a little bit more of a choppy picture. Combine that with the market breadth, and we see the same sort of idea. We see the bulls decreasing in strength, but we have yet to see the bears taking over. Once the bears take over, that's my sign to initiate shorts and look at targeting the 1272 along with the 100% as our very clear targets to the downside. Take care, and I'll see you in the next update.